A lot of people are wondering about the Timothy ETFs. Some of them are wondering about the differences between them. Some of them are wondering about the performance of the different ETFs, enhanced versus non-enhanced. So just wondering, Shanna, what do we make of these ETFs? How do we manage them well?
I'm going to kind of explain the difference. So there's two ETFs that also have an enhanced version. So there's one that ends in just the regular symbol and one that ends in an E, meaning the enhanced. So for the two that have the enhanced strategy with it, it has parameters for moving from the investments into long cash. And the purpose of this, and it also has strategies for moving back into the intended positions. Now, the purpose of this is to reduce some volatility. So, we don't try to time the market here at Financial Issues. This is probably the only two investments that have some type of timing mechanism with them. And, as I've tried to explain, which one do you choose, the regular version or the enhanced version? If you have a lower risk tolerance, meaning that, if my investment goes down 15% or more, I'm going to want to sell it. You probably should consider the enhanced version because it is going to limit some of the downside volatility. But anytime you limit risk, you're also putting a limit on potential return. So, we always encourage you not to try to time the market because you have to know when to if you're going to get out, you have to know when to get out and when to get back in. So, if you're going to do it even a little bit, these enhanced strategies have a well thought out set of rules that automatically happens. So if you're managing your own portfolio, if you're doing the individual stock portfolio, I would say just go with the regular version because we tend to manage our cash positions through the asset allocation model. So if for some reason, if we have a really good reason to increase the cash, we're just going to encourage you to do that through the asset allocation model rather than having another position that does that for you. Now, if you're using the mutual fund strategy, and like I said, I think one of the people were saying on here that they're down 7% in one position and 8% in another position, and they're asking if they should sell it. Well, that tells me they're probably in the right product because, had they been in something else, they might have been down a whole lot more than that. So, you have to be willing. Even if your targeted long-term return is, say, 7%, maybe you're a retiree, you're trying to be conservative, and you want to average 7% because, maybe you're going to take out 4% and you think inflation's going to be 3%. Well, you're going to need 7% average annual return to maintain your income in the future. So, if you're going to do that, you have to be aware that you're not going to see a steady 7% every single year. If you're invested in a diversified portfolio, you're going to see returns all over the place. If you're trying to manage risk and not have a lot of volatility in the portfolio, you're still going to have the potential to see years where your entire portfolio is down 10% or 15% or maybe even more than that. You have to be willing to stick it out and stick with it when you see those years. Now, from a historical perspective, and past performance is no guarantee of future performance, but if we look at what's happened in the past, those years happen and they're probably going to happen again in the future. On the flip side of that, when you see a good year, you see years that give you a return much higher than 7%. So folks, that's what an average is. Don't get too honed in on any one particular holding in your portfolio and think that, everything in my portfolio needs to perform the same, because if you have the same performance from everything that makes up your portfolio, you probably don't have a good diversified portfolio.